It is Tuesday, the 12th of July, 2022. Welcome to this edition of Business Redefined. Tonight, we're having a special conversation, the national tax policy after years of waiting and the Treasury indicating that it was being prepared. Finally, we have seen the draft version of it for stakeholder input. Tonight, we want to delve deeper into that conversation, and I'm privileged to have Edna Gitachu from PwC, where she serves as the tax policy lead, and Robert Waruiru, who is with us from Ichiban Tax and Business Advisory, where he is a partner. Lady and gentlemen, welcome on set. Let me just get straight into it. And before I get straight into it, there's a gentleman on Twitter who is asking, where is Christine Kahema now? I invited Christine to this panel. Unfortunately, her schedule could not allow, but we do appreciate the sort of input she normally brings into this conversation. Next time, she'll be here with us. So, Edna, let's start off with you. The national tax policy, the background here is that we've been having a conversation about the need to have a predictable tax regime in this country. One of the things which stood out for me in the draft policy is that tax law will change only once every 5 years. I'd like to know, what's your interpretation of that? Because my question is, does this mean we shall be seeing the finance bill once every 5 years?
Thank you, Julians, for having me on your show, and to our viewers, a very good evening. So, Julians, you're right in terms of the context. This is because, as a country, we have had very frequent changes, and unfortunately, the changes at times to touch on the same tax laws that were amended the previous cycle. And if I'm to give an example, for instance, if you look at the betting and gaming industry, in the last 5 years, almost every finance act touches on them. Another example that I would give was around the electricity rebates. So for the manufacturers, so the rebate was introduced in one cycle. The next cycle, we then had the regulations introduced, and the third cycle, we had the repealing of the provision. So what the draft national tax policy is recognizing is that this is causing a lot of instability in the tax environment. And to be able to address this, once a law is introduced, that law should be in place for at least 5 years before it is repealed. So in my view, it is likely that we'll still have a Finance Act every year because all the laws are not going to expire, the 5 years expiry, at the same time. There could also be instances where probably the National Treasury wants to make amendments. For instance, when we had the COVID-19 pandemic in 2020, we had the Tax Laws Amendment Act. So I expect that the Finance Act is going to be serving such purposes.
I see. Good introductory thoughts there. Robert, what's your interpretation of this? And broadly now speaking to you as well, is when you read the document, what's your general sense around it? I was trying to benchmark it around other tax policies we've seen from like Nigeria, for instance. What's your sense around it, Robert?
Yeah, thank you very much, Julian. So let's start with my sense of it. I think it's a pretty good draft, and it gives us a good starting point for stakeholder engagement. And really, that's what National Treasury is asking us to do as taxpayers. Citizens of this country, you pay taxes, interact with this document, let's have your feedback. And really that's what the National Treasury is asking. So from a policy perspective, I think it gives us pointers which are really useful, in terms of how are we going to structure the taxation laws of this country. Edna talked about the incentives. What kind of incentives are we going to give? What kind of sectors are we looking to tax? How are we looking to tax them? What's the objective of this tax? And so for me, I think it's a really good draft as a starting point. And obviously, we expect that the stakeholder engagement will then enrich it. Remember your first question?
The interpretation of the 5 years.
Oh, the 5 years. Okay, good. So now, in terms of the 5 years, I think, and I agree with Edna there, in terms of we're likely to still see changes. However, tax. In fact, one of the proposals is that it's got to be dynamic. The tax laws have to be dynamic and respond to changes in the economy. So, for example, the digital economy is growing quite fast. So, how do we catch up with the rest of the world? And so, I think there's going to be certain changes that are going to be happening annually. However, in order to assess the impact of a law, you need to give it time to be implemented by stakeholders, and so that we can then turn around and say, this is working or this is not working, and then what do we need to do? And if I may just give an example about the kind of policy that we have seen in this country. If you think about the kind of capital allowances that we have in this country, they were designed to support the economy of agriculture. And that's the reason why so many capital allowances are around agriculture and manufacturing. But is it time now we move to other sectors and start supporting or looking to optimize the tax in certain other sectors? So I think for me is a pretty good document as a starting point.
All right. Edna, one of the issues this country and many other developing economies grapple with is this issue of widening the tax net. When you read the draft policy, to what extent do you feel it speaks to this issue? And more importantly, I remember reading there that there's a proposition that we might have to go back the route of presumptive tax. Now, if you go back to FY 2018-19, we made an attempt at it, which wasn't very successful. So how do you feel it speaks to this issue of widening the tax base and drilling specifically to the issue of presumptive tax?
Yeah, thanks, Julians, for that. So looking at the issue of presumptive tax, I believe that the context under the draft national tax policy is for the hard-to-tax sectors. And this is specifically the agricultural sector and also the informal sector. This is not a problem that is unique to Kenya. It is actually an Africa-wide problem. And the rationale with presumptive tax, it assumes that you're going to make a certain profit margin as your business. And one of the things we need to then ask ourselves as a country and through the national tax policy, should we be having tax thresholds? So if it is an income, from an income tax perspective, what is our threshold? Because it will not be economical to chase after certain sectors if what you're going to get at the end of the day from a tax perspective is minimal. We need to look at the cost of collection vis-a-vis what we are actually collecting. But back to the point of presumptive tax, if you are to look at the two examples that are given in the policy, that's the agricultural sector, and specifically looking at the small-scale farmers, and I hope that they are not part of what the National Treasury is actually trying to tax. But if you look at their cost of production, it has been going up. Yeah. And this means that that assumption that they are making profits might not necessarily hold. If you're to look at the turnover tax rate of 3%, it assumes that the profit margin is about 10%. That may not necessarily be the case. These are low-margin businesses. So for low-margin businesses, a presumptive tax is likely to be an additional cost of business and therefore making it very unattractive for them to continue in business. And to be fair to them, they are also contributing their fair share of taxes, not necessarily from a direct tax perspective. It could also be indirect. Think about it. Any person, that mama mboga or the small-scale farmer that buys airtime is paying VAT and excise duty. Yeah. When you are transacting through mobile money, you're also paying excise duty. So it's not like they're not paying tax. It's only that the quantum is very low because their businesses are not as profitable as we expect them to be. So looking at agriculture, my view is that we should not focus on the small-scale farmers. We should go further up the value chain and see, because we are pushing for value addition from an agricultural perspective, how can we bring these people into the net?
I see. Robert, your thoughts on this, and really just to get your thoughts in terms of what would we be doing differently this time, given our previous experience with presumptive tax?
Well, the way I look at it, Julians, is Revenue Authority tried presumptive tax, or shall I say the executive tried presumptive tax, and I think there are certain lessons to be learned there. I think the first one, and it appears quite extensively in the draft national tax policy, is coordination amongst agencies and government, so that the national government has got sight of what county governments are doing. If you recall the presumptive tax that came in 2018, the idea was that traders pay 15% of the county business permit. Yeah? And so there was an issue about do county governments give you the business permit if you've not paid your 15%? And you remember that business permits are part of a big driver of own source revenue for counties. So it then became an issue of, counties, are they going to support the presumptive tax the way it had been structured? And I think the learning from there was KRA needs sight into this, into what these county governments are doing. And if you look at this document, it talks about bringing together revenue collection. And we've seen that with the Nairobi County government and possibly other county governments around the metropolitan. So I think that there's a very good reason or rationale to think that Revenue Authority will succeed in presumptive tax. However, the point that Edna is making is quite important, because we cannot then go after everybody. We need, and I think that's not really the intention of the policy. They're talking about going through cooperatives. You talk about hard-to-tax sectors, matatus, for example, maybe they're hard-to-tax. So let's go through the cooperatives, and that way it's easier for KRA to deal with that corporation or that body of persons who are in that circle or cooperative, and ensure that they are paying taxes. So I think there are certainly lessons that have been learned from a presumptive tax perspective, and I believe that there will be a study that will be undertaken so that you then determine which sectors are we going to go for, so that we are not going for everybody, because again, it's also got to be economical in terms of how you're collecting the tax.
Okay. We have 2 minutes to a break, so let me just get to Edna here very briefly. Let's get into the conversation around indirect taxes, and let's start with what for many Kenyans has been the elephant in the room, and that's excise tax. The draft policy clearly stipulates the areas which will be subject to excise. I was surprised to see that financial services was not amongst them, considering how much weight it punches around excise revenue from excise tax. What is the general feel around the categories prescribed?
Thanks, Julian, for that. So if you remember, when excise tax was introduced, it was introduced as a sin tax. And the policy seems to be going back to that. So over and above that, I think the only other category that we have seen there is the communication. So it appears that we are now going back to where we are at. We were initially, but just like you, was equally surprised. And I actually asked myself, is it a case of this is going to be introduced later on, or are we saying that we are going to forego excise duty on the financial sector?
I see. That point by Edna Gitachu takes us to a quick break. We shall be back with a lot more, focusing on the draft national tax policy. Remember, you can be part of this conversation by tweeting at NTV Kenya, at MbokoJH. The hashtag is Business Redefined. Stay tuned. Welcome back to this conversation on Business Redefined, where we are focusing on the draft national tax policy, and I'm privileged to have Edna Gitachu from PwC and Robert Waruiru from Ichiban Tax and Business Advisory. Ladies and gentlemen, welcome back on set. Before we took the break, Edna gave us some thoughts regarding the provisions on excise tax as per the draft national tax policy. Let me start off with Robert here. First of all, anything to add around that? We were both surprised to see that financial services were not included in that. And then there's a gentleman called Paul Wakanya who's saying, would like to hear the discussants' views on the ornament and cosmetics excluded from the general category of goods to be charged excise duty. Of course, this is with regard to Finance Act 2022.
Yeah, thanks, Julian. So if you look at the draft national tax policy, where one of the things that it says around excess duty in particular is to discourage consumption of harmful products. And then the other one is to achieve government objectives. Now, government objectives is pretty wide. It could be revenue objectives. It could be perhaps to deal with market imperfections like we've seen happening in Nigeria. So I think the fact that financial services is not specifically included there doesn't necessarily mean that it's excluded. And I actually think that it's a question of saying, let's have a look at how this will work and then figure out whether we still need it or whether we have now ramped up sufficient revenues that we no longer need to tax some of these sectors. And I think it's the same thing when you talk about cosmetics, because you can ask the question, what is harmful about the cosmetics? In fact, for most ladies, possibly they'll be up in arms. Why are you taxing it? You remember the excess duty on those products went up to 15% this year. So again, I think it's a question of not being exhaustive, and I don't think we should expect the tax policy to be exhaustive. It's a guide. It's a policy guide. You know, in fact, the word policy comes. It shares the same root with the policing, the policeman. So it gives us the framework within which we should operate as a country in terms of taxes. And so I think the fact that they are not specifically included doesn't mean that they are excluded or that they will not be considered in future should the need arise in order to meet other government objectives.
All right. Edna, on the issue of excise, one of the issues which the country has been grappling with is this matter of the annual inflation adjustment. So the question here is, when we say that tax law will be revised once every 5 years, when it comes to the inflation adjustment aspect, how would that work in that scenario where we are saying we need a band of about 5 years to be able to make adjustments? Many, I'm sure, would be curious to know your thoughts both around that.
Yeah, so Julian, as I answer that question, I'll not just answer it from an excise duty perspective, I'll also give it, I'll reflect on the income tax perspective as well. Our conversation as a country has been one-sided. We have been looking at it from an excise duty perspective because of raising of revenue. But who stops to think about the taxpayer from an income tax perspective, who is also being affected by the same inflation? So if you're to look at it from a pay-as-you-earn perspective, we also need to spell out in our draft national tax policy after how long will the pay-as-you-earn bands change. If you're to look at the reliefs that individuals are being given, or some of their allowances like pension, some of them have taken over 10 years before they are actually adjusted. So we expect that the draft national tax policy should also be addressing issues to do with inflation. And to your question, when it comes to excise duty, my expectation is that this is still going to continue on an annual basis. I know in the just ended finance bill cycle, there was that debate of whether it's going to be happening once every 2 years or once every year. I think that debate is going to continue. The optimal probably should be once every 2 years, and then we then need to agree if we are to adjust once every 2 years, what will be our base for adjusting? Is it going to be an adjustment where, even though it happens after 2 years, effectively we are adjusting for the other year that was not adjusted for?
Yeah.
Or will we be creative and come up with another way of adjusting to make sure that consumers are not paying too much because of this inflationary adjustment?
Robert?
No, I think I expect that the annual inflationary adjustments would happen. And like Edna is saying, I think it will be difficult. It will be a difficult pill to swallow when you say that the inflation has been 7% for 3 years, and therefore we are increasing the excess duty rate by 21%. I think you'll have a riot on your hands. So I think it does make sense to continue having these inflationary adjustments. And I think Edna has made very, very valid points around the expansion, and like she says, it took about 14 years for the PAYE bans to be expanded. But just speaking broadly as well around the tax policy, this tax policy talks about having 5 PAYE tax bans. You see, currently we have 3. Yeah. Previously we had 5. And other countries like the US have got 7. So again, it just gives us a guide so that we have a better understanding what are these rates and how do we expect them to change into the future. So I still feel that annual changes may be a thing to expect into the future. However, I don't think there'll be architectural changes within the law.
Okay.
Yeah.
Let's hold excise there because of time and switch on to VAT. Edna, first of all, just explain to us in very accessible terms this issue of VAT by destination principle. What does it mean?
So, Julians, this is an international principle, and what it provides for is that VAT is actually going to be taxed in the country of consumption. So if I'm to give an example, if today I import a vehicle, say, from Japan, the Japanese seller is not supposed to charge me VAT relating to Japan. But at the point of entry, the port of entry here in Kenya, I will then be charged VAT on that because I'm going to use the vehicle here in Kenya. So similarly, if I'm a manufacturer and I'm manufacturing goods here in Kenya and my customer is, say, in Uganda, I am not going to be charging my Ugandan customer Kenyan VAT. But once the goods cross the border and get to Uganda, then the Uganda law takes effect. And whatever VAT that is applicable in Uganda is then going to be paid there.
Okay. Robert, on VAT, the prescription by the draft policy that VAT should have a floor of 12%, first of all, I think it caught me by surprise. And why it did so is because if you look at the current regime we are in, effective July 1, for instance, LPG is subject to VAT at 8%. What is your take on that?
Well, and this is what I think this policy is calling for in terms of public participation and debate, because perhaps there is a case to be made to say, as a country, how do we want to tax certain goods which we think are, are important? And so, for example, fuel. Because it has a knock-on effect in terms of the entire economy. How do we want to tax it? Do we want to have a separate rate as well? Because the policy talks about 16%, a general rate, which is 16%, and then any other rate will be plus or minus 25%. In fact, if you look at the old VAT Act, it did have a similar provision, both a ceiling and a floor. And so the question then becomes, if, like Edna was saying, we get into a scenario where we need to give a rebate or a tax break to people, the 25% discount is the maximum that we can give. But that still does not detract us from having a lower rate for certain items, the same way we have got 0% VAT, for example. So for me, I think that's part of the debate that needs to be had in terms of what these policy proposals entail.
Okay. Edna, the question has been asked that does the draft national tax policy sufficiently address the issue of distortion when it comes to VAT, because we have almost multiple tiers. So you have 8%, you have 16%, you have those which are exempt, you have those which are VAT zero rated. When you read it, do you feel it addresses this issue of distortion within the VAT space?
I think, Julians, maybe if you are to look at the VAT as a whole, as a tax, one of the challenges we have with indirect taxes and VAT is the fact that the low-income earners are going to suffer the same VAT as the high-income earners. So what the draft policy is trying to do is to determine for the low-income earners, how do we cushion them? Although the list is not exhaustive. So for cushioning of the low-income earners, then we have a category of goods that are going to be exempt. Then we also have, and what my colleague Robert was talking about, items such as LPG. We need to then decide, are these basic commodities together with unga, your bread, and your milk, and should they be given special treatment? So I think that is what the policy is trying to address. And then the general rule of thumb is everything is VATable, subject to VAT at the rate of 16%, except where the government is trying to cushion the low-income earners through these exemptions, or where we are dealing with export of goods and services, which should then be zero-rated to make our country more competitive. So that's a general feel I have around the VAT issues.
Okay. Robert, I'd like us to switch gears and talk about the provision for special courts to address matters of tax dispute. The question that I have here, and which I've been debating with a few friends, is we already have the tribunal dealing with taxation matters, now have a separate arm, which is the courts. How do these two work?
Well, I think that's one of the very, very good suggestions in terms of this draft policy, and for this reason, Julians. So the Tax Appeals Tribunal is a specialized tribunal, and because it's quasi-judicial, which means it acts like a court, but it's not really a court. So it tends to then move faster, and it can dispense with tax cases a lot faster. However, if you look at the statistics that are available, last year KRA resolved 552 cases in terms of alternative dispute resolution, and I think it yielded about 31 or so billion shillings. Now, assuming those ones had not been resolved via ADR, you'd have had 551 decisions, possibly all of which would have been appealed to the High Court. So you're talking about clogging the entire justice system, and that's the reason why you see proposals like we saw in the finance bill around 50% pay to play, which we are very happy that it didn't go through. And in order for you to cure this, you need a special court so that you can resolve disputes expeditiously. And there's no magic in this, Julians, because if you look at the UK, for example, they're able to resolve disputes, high court cases, within 45 days of being filed. Yeah. So there's absolutely no reason why we shouldn't do this. And I think the starting point is to have those special courts. And just like we have the Environment and Land Court, we have the Labor Relations Court, it's time for Kenya to have a specialized tax court that can deal with these issues and unlock the revenue that we badly need.
Edna?
Yeah, I totally agree with what Robert has said. I think the whole rationale is how can we fast-track dispute resolution? As Robert has said, ADR is a fantastic mechanism, but not all the disputes will be resolved through the alternative dispute resolution mechanism. Some will filter through to the Tax Appeals Tribunal, and taxpayers may be aggrieved by the decision or even the Revenue Authority. So how then do we fast-track these cases that end up in court? So I think it's a really good idea to have a dedicated court system to deal with the tax dispute so that we can have faster resolution of the disputes. Remember, as an investor or as a business, anytime I have a tax dispute, I have to disclose that to investors. And investors coming into my business will look at that and say, probably this is not the time for us to invest. So it's in the interest of businesses to resolve their disputes very quickly. And similarly, it's also in the interest of the Revenue Authority to resolve the disputes as fast as possible so as to unlock this revenue.
Okay. There's a number of questions online regarding one issue here, and that is, what does the draft national tax policy say about the issue of tax refunds? And let me start with you, Robert, because there's a whole section in the draft national tax policy around tax administration. As you can imagine, this is a sticky issue for many. But maybe just to get your sense, when you read what is provided there, because it talks about streamlining the whole process, what would be your expectation? Maybe let's flip it, because it doesn't say too much about what should be done.
Well, actually, the draft policy suggests that they'll be able to refund or process refunds within 60 days, or at least that's the objective. Again, this is a really good proposal, because if you think about the outstanding VAT refunds, which and one of the good things about this policy is that it actually calls out the challenges. National Treasury is not shy about the challenges that the system has been presenting, and one of them is the tax refunds, which have been growing, and they are not being refunded, and therefore you're basically forcing government businesses to go out and borrow, which is a very expensive affair. And so the fact that they want to streamline refunds so that it's risk-based and you can get your refunds expeditiously. And we've again talked, Julians, in the past, that countries such as Rwanda, such as Ethiopia, which don't even have tax policies, by the way, but they process refunds within 30 days for Rwanda. So it's something that can be done and should be done. However, this policy still speaks about widening that tax base and ensuring a lot more people are paying taxes and there's less leakage, which means there's impetus for government to then refund this money expeditiously. And because a lot more people will be paying taxes, it means that there's actually funding to pay these refunds, and we can pay the refunds and then come and audit later, because a lot more people are now complying with their laws. So I think they're very ambitious, considering where we are today, very ambitious targets of 60 days, but I think it's doable.
I see. Edna, anything to add on this refund business?
Yeah, so 60 days is very commendable, but you also, when you look at it from a VAT perspective, VAT refunds arise from exports. From a service perspective, I think that probably needs to be cleaned up, because we are not very clear whether or not all exported services are going to be subject to zero rating.
Yes.
And ideally they should, and if they are, then it means that we might have more VAT refunds. So I think maybe the thinking here would be around, let's fast track the refunds, but at the same time, maybe even the audit can come later on. And if you look at some of the consequences, like in the Tax Procedures Act of paying interest, as my colleague Robert has said, a business is going to have a VAT refund but goes to the bank or to a financial institution to borrow. So how can we compensate them for that opportunity cost of borrowing? Yeah. So I think those are some of the issues that also need to be addressed in the national tax policy. I
see. Maybe, Robert, just to close on that issue of VAT refunds, the argument has been leveled time and again that maybe we need Treasury just to be appropriating and designating a kitty towards settling VAT refunds. Is this a view you'd share?
And I think that's definitely one of the proposals that the Institute will be making. And that also talks to an amendment to the Public Finance Management Act, because that's where the problem is. Because KRA collects and then puts all the money into the exchequer, and then you've got to get the money out of the exchequer to then pay the refunds. One other thing that I should say, Julian, around these VAT refunds is that there's a proposal to apply what is called the de minimis rule. And the way I understand that is to say VAT refunds of up to a certain threshold will be paid, and then we'll look at them later. Yeah. Because we don't think that there is a significant risk, and we think based on a risk-based approach, these are taxpayers who are entitled to that. Again, that should help taxpayers, or should help businesses to unlock this fund, so that if I've got a refund of say 100,000 shillings and somebody else has got a refund of 200 million shillings, surely the risk profile is different, and you should be able to refund me faster than perhaps the person with a larger refund. So that's also a good proposal.
Okay. Let's get to the tail end of this conversation. My director tells me we have about 6 minutes to go. So let me start with Edna. The question which is emerging online is, what are some of the best practices from a tax policy standpoint that Kenya can borrow? I appreciate in Africa we don't have too many examples apart from Nigeria, but what are some of the issues as you come through this document you're looking at?
I think one that comes to mind, and benchmarking against Nigeria, is that looking at the Nigeria tax policy, there is a very deliberate shift of focus towards indirect taxes. And this is on realization that it might be probably less difficult to evade the indirect taxes because they are consumption-based. I know there's this whole argument that for the indirect taxes, the low-income earners will also be hurt as much as the high-income earners. So as I said earlier on, it would be important for us to cushion them by making sure that the goods that are bought by the low-income earners, that's your bread, your maize, flour, your whatever it is, milk, LPG, have probably a special treatment from a VAT perspective. Then another issue that we have seen is around the reduction in income tax rates. So in Nigeria, as they increased the the VAT focus, then there was a commensurate reduction in the income tax rates. So this is perhaps one of the things that we probably need to borrow as a country.
Robert?
Yeah, I guess in addition to what Edna is talking about, one of the things that I really like about this proposal is the establishment of an ombudsman, a tax ombudsman. Basically, the challenge here that Revenue Authority is calling out, or National Treasury is saying, even when we want to do alternative dispute resolution, the party who you're going to engage with is still the commissioner who has assessed you. And so we need an arbiter who can try and arbitrate this dispute for speedy resolution. I think that's a really good one. And we have seen that in South Africa, in the UK, and in India as well. So the other one is just the entire thing, the entire aspect of expanding the tax base. Yeah. And if you look at, for example, Tanzania, who don't have a tax policy, but if you look at what they're trying to do in terms of expansion of that tax base, they are tying it to the education registration that people have, so that by the time you get to 18, you automatically become a taxpayer. Yeah. And now you tell us why you're not paying taxes, and not the other way around, where Revenue Authority is chasing people to register for tax. I think some of those proposals will definitely help expand that tax base. And the idea here is, when we have more people paying taxes, 8.2 million according to the estimates for next year, if you've got 8.2 million people paying taxes, then there's reason to argue for a reduction in income tax rates.
I see. We have 3 minutes to go. Let's get to the closing remarks. Let me start with you, Edna. 1.5 minutes. What's your take home? What is the parting shot in this conversation on the draft national tax policy?
So, Julians, as my colleague Robert said, this is a very good start. We have been asking about a national tax policy for very many years. So it is very, very commendable that the National Treasury has released this. I expect that there will be a lot of public participation on the same, and it's my hope that the views of the public will also be taken on board. If I'm to look at a policy like Nigeria's, it took about 10 years, and it's because they went through very rigorous public participation. So I'm hoping to see the same from a Kenyan perspective.
Robert, your closing thoughts?
Yes, so this is a good draft. We all agree it's a good starting point. And the one thing that we have to appreciate, and I'm on record as commending Revenue Authority, though that's not my job, they have actually started implementing some of these things. So for example, the digital economy, they actually have a specific office that deals with the digital economy. They have a specific office that deals with international tax. So it's something that I think will get off to a good start in terms of implementation. And as a member of ISPAC, I really ask the public to interact with the document, give us your proposals, let's all work towards a better country in terms of tax fiscal policy.
Thank you so much, Edna Gitachu from PwC. Thank you so much, Robert Waruiru from HBAN Tax and Business Advisory. Unfortunately, that's all the time we had for this conversation. I've got tons of questions here, but time wouldn't allow us. And someone is asking here, why haven't you discussed the issue of the tax performance for FY 2021-22? Well, that's a conversation for another day. So stay tuned to NTV for more programming. We shall continue highlighting issues regarding taxation in subsequent episodes. Stay tuned.